Welcome to the deep dive. Our mission here is pretty simple. Take the info you give us, maybe research, articles, or like today, details from a company's conference call, and just pull out the really important stuff for you.
Exactly. We sift through it so you don't have to, giving you the key takeaways quickly, helping you get informed on what's really going on.
And today we're diving into Argan. We've got details from their recent call discussing, financial results, what they're working on, all that.
Yep. We'll unpack the numbers, look at what's driving the business, how the different parts are doing, and check out their financial health and outlook.
It's about getting you the essential story straight from the information provided.
Let's do it.
Okay, so let's jump straight into the numbers. We're talking about their first quarter of fiscal 2026, which ended back on April 30th, 2025. And the headline figures look pretty solid.
They really do. Consolidated revenue, so overall revenue was up 23% compared to last year, came in at $193.7 million.
Okay, 23% growth. Not bad at all. And did that flow through to profits?
Oh yeah, big time. Net income, the bottom line was around $23 million.
$23 million. And per share?
That translates to $1.60 per diluted share. And get this, that's up from just $1.58 a share in the same quarter last year.
Wow, 58 cents to $1.60. That's a huge jump.
Massive. Over 170% increase in earnings per share. Definitely a highlight.
And they mentioned EBITDA too, right? Another profitability measure.
Right. EBITDA, earnings before interest, taxes, depreciation, amortization. It's kind of like a proxy for cash flow potential. That number jumped to $30.3 million. Last year, it was $11.9 million.
So more than doubled there too.
Yep. And as a percentage of revenue, the EBITDA margin went from 7.5% last year up to 15.6% this quarter.
That kind of margin expansion is, well, it's pretty significant. What about gross margin?
Also a big improvement. Consolidated gross margin hit 19%. Last year it was 11.4%.
Okay, nearly double digits last year to almost 20% now. That's a substantial move. What did they say caused that?
They talked about a couple of things, mainly a changing mix of projects they're working on and also the types of contracts they're using. Different projects just have different profit levels built in,
Makes sense. And wasn't there something dragging down last year's number too?
Exactly. They mentioned a loss they took on an overseas project last year. So that wasn't repeated this year, which obviously helps the comparison. It's sort of a mix of better current projects and lapping that prior issue.
Got it. So strong Q1, overall, good revenue growth, really impressive profit improvement, sets the stage nicely. But looking ahead, what's fueling things? The pipeline? Backlog? That seems key.
Absolutely crucial. And the big news here is the backlog. As of April 30th, it hit a record $1.9 billion.
$1.9 billion. How does that compare to, say, the end of the previous quarter?
It's up 36% just since January 31st.
36% growth in the backlog in just 3 months. That's really fast.
It is. Shows are winning a lot of work right now.
And this huge backlog, it includes a major new win, right?
Yes. They got the full go-ahead, the notice to proceed for a really big one. A 1.2 gigawatt natural gas plant. It's an ultra-efficient combined cycle design.
1.2 gigawatts. That's a serious power plant. Where's that?
It's for a company called Sandalake's Energy Company, SLEC, down in Texas. And they expect to start building it this summer.
Okay, so that's locked in. Beyond that specific project, what about the overall pipeline? What trends are driving demand for companies like Argan?
They see a few big things happening. First, just the basic need to replace old power plants.
Yep.
A lot of the existing natural gas fleet is aging out.
Right, simple replacement cycle. What else?
There's also this real urgency to build new stuff because power demand is growing like crazy. Unprecedented growth, they called it.
And where's all that demand coming from?
Well, they pointed to a few specific drivers. You've got AI data centers needing just massive amounts of reliable 2047 power.
Mm-hmm. We hear a lot about that.
Then there's the onshoring trend bringing complex manufacturing like chips or chemicals back to the U.S. Those plants also need huge amounts of power. And of course, electric vehicles. More EVs mean more demand on the grid over time.
So it's replacement and brand new demand from tech and industry. Now, Argan calls itself energy agnostic. What does that mean for the kinds of projects they build?
It basically means they're not tied to just one type of power source. They can build natural gas plants, which is sort of their bread and butter, but they also do solar projects, biomass, even battery storage systems. They position themselves as able to handle whatever energy infrastructure is needed.
Okay. But looking at that actual $1.9 billion backlog right now, how does it break down? Is it mostly gas or renewables or
Right now, it leans heavily towards natural gas. It's about 67% gas projects and roughly 28% renewables.
67% gas. Is that mix likely to change? What did management say?
Their expectation, based on what they're seeing in the pipeline, is that natural gas projects will actually continue to increase as a percentage of the backlog in the near to midterm.
Interesting. So even more focus on gas coming. Seems like it. They see it as the core growth engine for now, really driven by that need for reliable power to support the grid, especially with all those demand drivers like AI and manufacturing. They'll still do renewables, but gas looks like the main focus for growth ahead.
And they sound confident they can keep adding to that backlog.
Very confident. Management specifically said they expect the backlog to go significantly over $2 billion later this year.
Wow. Okay. So great Q1 numbers, record backlog, strong pipeline focused increasingly on gas. How does this play out across their different business segments? They have three main ones, right?
That's right. Power industry services, that's the big one. Then industrial construction services. And the smallest is telecommunications infrastructure services.
Let's start with power. That's the core, right? How did it do?
It was definitely the star of the quarter. It made up 83% of total revenue. And its revenue grew 45% year over year, hitting $160 million. Pre-tax income from this segment was about $31 million.
And those great consolidated margins we talked about, were they mostly from this power segment? Absolutely. The gross margin just for the power segment was 20.6% this quarter. That's way up from 10.2% last year. So yeah, this segment's performance was the main reason for the company's overall strong profitability.
Okay, makes sense. What about the second segment, industrial construction? How did that perform?
Revenue there was actually down. Came in at $29 million compared to $44 million last year. So that was about 15% of total revenue, and it added around $2 million in pre-tax income.
Why the dip in revenue for industrial?
They said it was expected, really just due to the timing of specific projects in that segment. You know how construction goes? Revenue isn't always smooth quarter to quarter. Depends where you are in the build cycle.
Right. But did their future work, the backlog, grow for that segment?
Yes, it did. The industrial backlog actually increased to $91 million, and they expect revenues for this part of the business to pick up meaningfully in the next few quarters.
And what's driving that expected pickup?
They pointed again to that U.S. manufacturing onshoring trend, especially in the Southeast, where this segment does a lot of its work, building facilities for those returning industries.
Gotcha. And wasn't there a leadership change mentioned there?
Yes, just briefly. Sean Terrell was appointed CEO of TRC, which is one of their companies in that industrial segment, part of a planned succession, taking over from Bobby Ford Jr.
Okay. And the last smallest segment, telecom infrastructure.
Yeah, pretty small contributor. Only 2% of revenue this quarter. Margins were decent, though, around 18% gross margin. So they're still active there, but it's not a major driver right now.
With all this work, especially the big power projects, did they talk about having the people needed?
They did.
Yeah.
They mentioned they'd been proactively investing in their workforce during the previous fiscal year, fiscal 2025, specifically to get ready for this bigger project load they saw coming. Hiring and training.
Good planning. And they rattled off a few specific projects too, didn't they? Just to give a sense of the work.
Yeah, a whole list. Like the Trumbull gas plant in Ohio is almost done. That big new SLEC gas plant in Texas, starting soon. A biofuel plant in Ireland just kicked off this quarter. Another big 700 milliW gas plant in the U.S. Some work for an LG facility in Louisiana. A large solar project in Illinois. Finishing up some solar plus battery storage projects. And even a couple of water treatment plants from the industrial side.
Okay, so a wide range of large, complex projects. Let's shift to their financial strength. How's the balance sheet looking?
Very, very strong. As of the end of April, they had about $546.5 million in cash and investments just sitting there.
Over $500 million in cash. Wow. And no debt, you said?
Correct. Zero debt on the books. Their net liquidity, basically ready cash minus any immediate obligations, was $315 million.
And did that cash pile grow during the quarter?
It actually increased a bit, up by $14 million from the end of January. So they're still generating cash, even with all this activity.
And their business itself, building these plants, doesn't require them to spend tons of their own capital.
Right. It's a relatively low capital expenditure business model for Argan itself. They're building for clients, not building their own factories or anything like that. That gives them a lot of financial flexibility.
So what do they do with all that cash and flexibility? What's their capital allocation plan?
They laid out a few priorities. First, like we just mentioned, investing in their people, making sure they have the team. Second, paying a quarterly dividend to shareholders.
And that dividend has been going up, hasn't it?
Significantly, yes. They pointed out they raised it again, effective September 2024, to 0.375 cents per share quarterly. That makes the annual rate $1.50 per share.
Okay.
And they noted that followed another increase just the year before in September 2023 when they raised it to $1.30 quarterly. So you put those together as a 50% jump in the annual dividend payout rate in less than 2 years.
That's pretty aggressive dividend growth.
Right.
What else are they doing with cash?
Share repurchases, buying back their own stock. Since late 2021, they've spent about $109.4 million buying back shares. And just in April, the board boosted the authorization for that program up to $150 million total. So more buybacks likely ahead.
Okay, dividends and buybacks. Any mention of acquisitions, M&A?
Yes, that's the other potential use of capital. They said they're always evaluating M&A opportunities, looking for things that could add to their business or complement what they already do, but they stressed they'd be disciplined about it.
Right. So strong finances, low capital needs, returning cash to shareholders, open to deals. Seems like a solid financial picture. What about the overall outlook? How are they feeling about the market?
Overall, very optimistic. They see growth continuing, not just this year or next, but potentially, right through the decade and maybe beyond. It all comes back to that fundamental need for more power infrastructure.
Did they comment on how long it takes to build these big plants these days? Has that changed?
Yeah, they did mention that. Historically, a big combined cycle gas plant might take, say, 2.5 to 3 years. Right now, they're seeing typical timelines closer to 3 to 4 years.
A bit longer. Why is that?
Primarily supply chain issues, they believe. Just getting all the specialized parts and equipment takes longer now than it used to. It stretches out the whole construction schedule.
Makes sense. We hear that a lot. But despite those delays, they feel like they're in a good spot.
Yes, definitely. They feel their expertise, their financial strength, their relationships, and their track record. Building these complex projects, both gas and renewables, puts them in a strong position to win their share of the work that needs to be done for grid reliability.
Okay, so let's wrap this up. If someone just listened to this deep dive, what are the main things they should take away about Argan right now?
Well, first, they kicked off their year with really strong financials, good revenue growth, but even more impressive jumps in profit and margins, mostly thanks to their core power business.
And they've got that record $1.9 billion backlog, which grew incredibly fast last quarter, anchored by that huge new gas plant project in Texas.
Right. And the market they're in has some powerful tailwinds, old plants needing replacement, plus soaring demand from things like AI, factories coming back onshore, EVs. It creates this big long-term need for what they build.
And it looks like, at least for the near to medium term, their growth is going to be heavily focused on natural gas plants, which they see as critical for keeping the lights on.
Exactly. Plus, they're financially rock solid. Tons of cash, no debt, low capital needs. That lets them reward shareholders with dividends, which they've been raising aggressively, and buy back stock while still having firepower for potential M&A.
They sound quite positive about the future, even acknowledging things like longer project timelines due to supply chains. The core demand seems strong.
Yeah, that's the picture. Good current momentum, a favorable market environment, and the financial health to execute.
Okay, so here's something to maybe chew on after listening to all this. We know these big energy projects take years to build, right? 3 to 4 years currently. And we know the energy world is changing fast, more electrification, but also this urgent need for reliable power as old plants retire. So when you see Argan's backlog booming, but with such a heavy and increasing focus on natural gas, what might that signal about the actual pace and the real-world mix of the energy transition that's getting built on the ground over these next, say, 3 to 5 years? Something to think about.